Good morning, everybody. I'm Pete Renzulli, Class B member, T3 Trading Group.
And I'm Jill Malandrino with The Street, and together we bring you the morning call. Pete, we're in the last week of summer trading. We had 2 down days, 1 flat following GDP data, and we are going to that all-important Jackson Hole with some Bernanke speeches and so forth. So looks like we're kind of going to be in that inside type of range until we have that lowest level since 2008, excluding holidays. So there's really not much to work with here.
It's a lot of indecision right now. We're getting QE3, we're not getting QE3. I know I read last night Dennis Gartman went flat all of his equities right now. Very well respected. Do you trade off of what he did? No, but the charts are telling you right now that there's a lot of indecision. We haven't really moved. We're closing and opening in basically the same spot. We're not really breaking out to new highs with any kind of consistency. We're pulling back and we're making new highs, but you can't really look back and say, wow, did you catch yesterday? We really haven't had that. I think the swing traders right now, maybe a little bit longer term position traders, are benefiting more from the slow grinding move that we're having right now.
Right.
The one thing from being a little bit of a market veteran, slow grinding moves last longer. And I think that's what's frustrating a lot of the bears right now, because from a trading perspective, you're seeing that we're going up, and we're going up so many days in a row, but we're not blasting off where you could say we're clearly going higher, like the levels in the SPYs that we talked about, 1422 to 1440. So the bears are getting short and not quite getting hammered, but clearly losing money on a consistent basis because we haven't rolled over. So you have to be careful that these are the kind of moves that can last a while.
Well, I mean, it's been a huge frustrating year in 2012 for the bears because the markets are up, significantly for what people did not expect to really not be much of anything this year. And we've had some true have and have-nots in terms of sectors. And when we get into the trenches, we're going to talk about your investing style, as it's a little bit different than Scott's. We'll take a look at some other areas that we haven't reviewed before. But before we do that, let's take a look at the charts and review some levels in the SPX going into trade today and tomorrow.
Sure, absolutely. Something we talked about a little bit. At the end of the day, usually here we're up or down or whatnot. We really haven't been up or down that much. It's just they have to say something. But if you go to the charts here, clearly the levels in the SPX, we're at 1410 right now, just below us 1401 for the 21 EMA on the daily, just above us 1420. We're not really going anywhere right now. From putting a risk on. From being a trader, you have to say, does the risk justify how much is potentially available to earn right now? So on the SPX, we're looking at 1422, we're looking at 1440, and through that level, we have some pretty decent room to go. So when you calculate in how much we've already gone the last 2 months and the most significant levels that we have to get through right now, the better reward potential is if the SPX gets through 1422 from a broad-based perspective. So I'd keep that level in mind.
Okay, great. A key theme that Scott and I take a look at are the haves and the have-nots, and the housing and housing retail names have clearly been outperformers this year. We're going to kick it off and take a look at Home Depot, one of the haves within this subsector versus another name like a Lowe's. Home Depot has just been really outperforming. Past 5 quarters have, clearly it's the tail of the tape. We're continuing to hit 52-week highs here. Do you, get involved with the trade here and try and catch some of that momentum, or do you kind of take a step back?
No, absolutely. Going to the charts here in Home Depot, we actually had 52, 50, 53, going all the way back to 2002 was a pretty significant level. Pulling it up, I did not personally think we were going to get through this level. We eventually did push through it, and there was a price target raised on it to 70 last week. And you can see here, earnings, push up, gap, hold. It's perfect technical analysis. Gap, hold, light volume during the pause, above every key moving average. There's no reason not to be long at this point, and especially if you go back to the monthly charts. We've had basically 10 out of the last 12 months have been closed above the open. So again, getting back to that slow grinding move, we talk about volatility. Like, you don't necessarily need massive volatility, you just need it to be obvious.
Right.
And you have to know what type of trader / investor you are, and absolutely being long this is the right thing to do.
So if we take a look at Lowe's, for example, on the charts, which has not been performing as well as Home Depot's been, do you just stay away from it completely, or is it short here, or just focus your capital on Home Depot?
I think with something as obvious as what Home Depot is doing right now, you might as well be there.
Right.
There's you can absolutely say there's relative weakness relative to Home Depot's strength. But really what you want to do is you want to go to the best stocks in the best sectors. And right now, Home Depot is outperforming. So there's no reason to be on the other side of Lowe's when Home Depot is doing what it's supposed to.
Right. Now, moving along to a home builder itself, Toll, this is one of those names in 2008, 2010. I mean, it was just continuing to bleed money. 2011 sort of leveled off. And now 2012, they're looking to actually, increase profits 2 to 3 times. But I think what the key here is how much they beat on consensus. So I think that's a theme that we're going to be looking at for the home builders, your Tolls, your Lennars, your KBHs, but Toll's been performing pretty well here.
Look, this sector has turned around a lot. I've been on this sector like a I just sold my house. And to sell my house now for more than I bought it for a couple of years ago tells you how strong the demand is out there right now, whether it's new homes or stuff that's already out there. You can't, and especially looking at the monthly chart here, we've closed above the open now for 11 months in a row. Is it massive volatility? No, but the stock has doubled in that period. Doubled for the sector that everybody has been bashing for a long time now. 3% interest rate, 2 3/4, and my brother just refinanced. He's right in that 3% range. There's been a lot of reason to get involved, and they did what they were supposed to do. They helped it. They helped this sector. It's turning around. You definitely want to be looking. Now the question is, the levels that we're at right now, do you get involved now after a stock has doubled?
Right.
Depends on your time frame. If your time frame is a little bit longer term, we're still pointing up. There's no reason not to be looking at the long side. It's just, do you get long while we're at new highs, or do you wait for pull-in, Fibonacci levels, whatever number you use? I like the whole sector long. It's just a question of where.
Okay, let's wrap it up with Weyerhaeuser. This is a name that Stephanie and Kramer really bolt up on, and we own it in Action Alerts Plus. Hit a 52-week high. It was up 5.5% yesterday. Is this another one that we kind of hop on board with?
Well, from a technical perspective, you can see it bounced up, touched the 2011 highs, and now it's consolidating at those levels. In the tape that we're in right now, as strong as the sector is, you want to see first, you want to push through that level first. You don't want to be the person a month from now says, I bought it at resistance and it pulled in. Of course, it didn't follow through. So because we're in kind of more of a broader base, slower, grinding type move, in that environment, you want it to push through, pause, and have a little bit of conviction before you start to get involved. So I like it at these levels. Just above this 25 level is really where it's confirming the breakout. Let it get above there, stay there for a few days, but the pause just in front of the level is constructive, because if short sellers are going to come in, you get up to that level, they shove it down right away. It didn't happen here, so you got to like it above 25.
Okay, going into the trenches, we are going to look at investment and trading styles. Switch it up a little bit. And Pete, you and I, we tend to be a little bit more longer term, not quite momentum traders, a little bit less beta in the portfolios that we trade. So tell us a little bit about the sectors that you have been looking at in 2012 and what stocks you're involved in the basket that you have going right now.
It's interesting. We talk about have and have-nots, and we've had opportunities on both sides of the market. I do trade the retail stocks. I'm a Macy's, Costco had earnings this morning. Out of that whole batch, the only one that I really don't get involved in that often is JCPenney. They brought over the guy from Apple, and it's been chaotic from a trading perspective. You have these moves where it goes straight up or straight down, and there's just no rhyme or reason. But then you go to something like Macy's, where it's basically been in a really nice slow grinding uptrend for a year. And that's the stuff that you want to be looking at. You want to be going into stuff where it's obvious. And again, getting back to your question before, do you short Lowe's against Home Depot being strong? No, keep your money where it's obvious. So Macy's, Target, Kohl's, they've been obvious. Heading into school, of course. What's the difference? What the reason is, they're obvious right now, and that's where you want to put your money. Right.
Well, also from a fundamental perspective, you also have Macy's. They've got that great balance sheet, and they also pay a nice, healthy dividend. So you're getting a lot of fundamental money going to that as well, which tends to be a little bit more long term. What's another sector that you're looking at outside of retail?
Well, have-nots, if we can touch on that for a second. Fast food has had a bad summer. I mean, there's no other way to put it. We'll start out with CMG. Okay, got crushed and is staying there. That's the big thing. McDonald's. Again, from a trading perspective, we pulled back basically the entire year here so far. What else do we have in the list? Coke, KO. Clearly on the way down here. And last but not least, again, not massive volatility, but definitely a tradable stock. The Starbucks missed last month, pulled back. Now it's basically a 50% retracement here, which is a level where somebody would normally look for a new entry. And I will actually be looking to short Starbucks this morning. It didn't quite fill the gap, got pretty close. The gap was a little bit higher. But this is an area now where we consolidated for a few days after we have a short covering rally, which is very interesting, the difference between new buying and a short covering rally. After a down move, a slower grinding move is usually new buying. We had a short covering rally based on how fast it happened. Right. So it's people getting out of shorts, getting out, and now that that's kind of slowed down a little bit, if Starbucks opens flat today, I'm going to short it against yesterday's high. All
right, let's move along to quick hits for some quick cash and take a look at some of our favorite momentum names to trade. We're going to kick it off with Apple. We have the iPhone, iPad, talking about maybe the ITV going to the end of the year. Back to school is also going to be key for this stock, and then you also have the whole Samsung legislation, which people don't think is necessarily over yet. So you're still going to get those headlines. You're still going to get a lot of momentum to trade off of. I mean, people have made careers out of trading this in 2012.
People have made retirement accounts.
Yes,
in a year. I mean, just think about the percentage. I mean, was it 280 to 580 and then took off again? But from a technical perspective, if we go to the charts here and we look at, we finally pushed up through this 620 level, and Just from a, I don't want to go and say a lesson or anything like that, but you need to know what you're looking for in order to be having conviction in a particular trade. And this one here, kind of what we were talking about at WI before, it gets up to that level. You want to get a little bit of conviction just through that level. The longer it stays above the level, the more conviction you're going to have in wanting to be in the position. This push through 620 stayed there for a week and then took off and went up and had the 680 number, and we're kind of like dancing around here. The one thing I will say, I'll put myself out there just a little bit. Now, I know the whole community loves to trade the stocks. Accumulation distribution in stocks going back 100 years, normally accumulation after a big down move, it's quieter, but volume increases. Tops normally happen where it's wider, whippier price action with bigger volume, and that's normally where you start to see a stock start to roll over. And we're starting to see that a little bit here in Apple. And I'm not calling it top.
Right.
What I am saying is, as a trader, you have to know what you're looking for, so you can see if it's there or if it isn't. One of my first mentors said, if it's hard to find, it's not there. In this case here, we are starting to see higher volume, a little bit of whippy action. So I think you're going to get slapped around in the stock a little bit until it either consolidates or takes out the most recent levels.
Well, I think it's really key that you point that out, where you're not putting yourself out there saying that it's a top, but I think what traders get stuck in with Apple, from momentum traders, long-term traders, that they fall in love with the product and this, like the company itself, and they don't focus on what to look at in the stock because it gets a little bit emotional. So I'm really glad that you pointed that out. Let's move along to Google. It seems like this stock keeps moving up as Facebook and all these other social media names just completely. I mean, what a year it's been.
Well, it's exciting to see Scott's January call.
Yes, start to play out, right?
You know, he took a little bit of heat when it first happened, but you know what? As a trader, or even somebody who's managing your own money, you make a call based on what you see, and then you manage risk. Scott made the call, and we're starting to see a little bit later in the year it's playing out. So the call didn't work out exactly then. When you're managing money, it's not about being perfect on every trade. It's about managing risk and then hanging on to the ones that work. So if you like the idea, which we talk about even on a short-term basis, there's nothing wrong with getting stopped out and then looking for another spot. All the key moving averages are in the right direction here. We're taking out key levels. And again, very similar, if you look at the chart in the top left here, we took out the monthly resistance, which is going back, obviously, forever in this particular stock. And now we're pausing above that level, and it's looking very healthy. Now, heading into today, there's going to be two different types of openings to trade this stock today. Because we're up 3 days in a row, $659, let's say $660 to $690, $30 in 3 days, close to that number.
Right.
You can't be buying a higher opening this morning. The percentages just don't dictate, after 3 strong days like that, buying a higher opening. So the better trade today is to wait for it to pull back right around the 580 level. Like I said this morning with the SPX, the better trades have been waiting for it to pull back and then bid into those support levels. So you got two different trades on the open today. A higher opening, I would let it go, or look to book profits. Lower opening, look for a spot to bid intraday around 680.
We've been managing Google like we've been managing the ag names as well. And June 4th seems to be a really key day in terms of that reversal, where sectors that we were looking at, like the high beta tech names and the ag names, really took off from there. Let's look at a more longer term idea, IBM. I happen to love this name. Evan and I traded this a lot at the end of last year when it was trading at much lower levels where it is now. I would still get involved here. You're getting paid with that dividend to hold on to it. You're not going to get fired for having a name like IBM in your portfolio. It's up 14% year to date, 46% year over year. I think it's a great core holding to have.
From a trading perspective, I disagree just a little bit getting involved now, and I'll give you, just going back to the charts, from a risk reward perspective, because that's everything that we do, is how much risk do I have to take for how much reward's available. Okay, I absolutely like the stock, but not until it's over 200. If you look in June, June, and twice in August, it got to 200 and couldn't stay there. As a matter of fact, the last time it got there, it pulled back quickly. And now we're actually below the shorter term moving averages that we look at on the daily chart. So once, twice, third time. Normally it's 3 times, knock 3 times, and you go through and you get a push. This time we didn't get it. I like it better above 200, and again, very similar to the other patterns. Get above 200 and stay there, versus as soon as you get to 200, the sellers come in and push it back. So the reward potential right now doesn't justify taking the risk. If you have to risk $5, just for argument's sake, in the shorter term window that we're looking at, to make 5, then you're going to be a break-even trader on the trade. You want the risk-reward to improve, which means it's got to get through 200 convincingly.
Well, it's interesting because IBM tends to, if history proves anything, it tends to split over 200. So could be, that could be. The reward potential, it does change it a lot.
Absolutely.
Let's wrap it up with Walmart. We know Pete likes the retail names, Target in particular. Walmart's had quite a year. What do you think of this one?
I think we're starting to see the weekly charts break down a little bit here. It had a phenomenal run, and I'll be honest with you, I tried short selling a couple of times, again, for that reason, where it was just that slow grinding move that did not say like, oh, you're really wrong on the shorts. It didn't pay. Same thing with Citigroup. Maybe we mentioned Citigroup a little bit before we finished today. The $590 million lawsuit yesterday.
Right.
I've been shorting it. There's been a bid below the market. They've been crushing the bid, and the stock goes down a nickel. And now the news comes out, and let's see if it pops again. But Walmart, you start to see the cracks first on the shorter time frames, and obviously we were up, then we gapped down, and we haven't filled the gap from about 10 days ago. And now we're actually hovering right around those key short-term averages. So we didn't fill the gap. The weekly charts now, 3 of the last 4 weeks have closed below the open. So on a week-to-week basis, I know that takes a lot of the T3 traders out of the window where they're looking at 5-minute charts. But if you look where it opened on Monday and closed on Friday, 2 of the last 3 weeks we closed lower. So we're starting to see cracks in the buying that we have seen. Now, I'm not saying it's necessarily a short sale, but from a do I put some trades on here in this stock perspective, it's heading in the opposite direction right now. So you want to see it start to push in your direction first, where it opens here and closes here a little bit, so you have a little bit of short-term conviction in the direction of your longer-term idea. So I like it, but not right now. I want to see a little bit of an impulse to the upside, maybe even fill that gap. But even if it does, 75 is the resistance level. So then if you see that push up and then you have 75 as a dollar away, do you get involved with the dollar potential?
Right. The risk reward isn't really there.
Exactly.
All right. Sounds great. Thank you very much, Pete. Don't forget, guys, at the end of the day, the T3 Live team wraps it up on Options Profits, Real Money Pro, and T3Live.com. Have a great week, everyone.